Have you ever wondered why two traders can use the exact same strategy, yet one makes consistent profits while the other blows up their account? It's not the strategy. It's not the indicator. It's not even the market. The real edge in trading isn't hidden in some secret formula. It's in consistency. The ability to show up every single day, stick to your plan, manage your emotions, and let time do its work. This video isn't about teaching you the next hot setup. It's about something far more powerful, mastering yourself. Because once you learn to stay consistent, your wins compound, your losses shrink, and trading finally becomes sustainable. If you've been chasing strategies, signals, and shortcuts, this video will help you discover the truth most traders never learn until it's too late. Consistency is the ultimate edge. Chapter 1. The illusion of the perfect strategy. Have you ever spent hours searching for that one perfect trading strategy that will make everything click? Maybe you bought a course, watched dozens of YouTube videos, or scrolled through hundreds of charts hoping to find the golden setup. And yet somehow, it never works like you imagined. You make a few wins, then the losses hit, and suddenly that perfect strategy feels more like a cruel illusion. Here's the truth. Most traders fail not because the strategy is bad, but because they are looking in the wrong place. They chase strategies the way people chase diets, miracle gadgets, or shortcuts in life. They think if they just find the right formula, success will automatically follow. But in trading, like in life, there is no magic formula. The edge doesn't come from a chart pattern, an indicator, or a complex algorithm. It comes from the trader. Consistency is the invisible force that separates winners from everyone else. I remember my early days in trading. I spent months hopping from one strategy to another. I tried scalping, swing trading, trend following, mean reversion, you name it. Each strategy looked amazing on paper and in backtests. On the first few trades, I felt like I had cracked the code. But soon, the losses started piling up. My account would spike one week and collapse the next. I blamed the strategy, the market, even my broker. I didn't realize the problem wasn't the strategy. It was me, my inability to stick to one approach, my emotional reactions, my impatience, and my lack of discipline were the real culprits. This is the trap most traders fall into. It's easy to convince yourself that the next strategy, the next indicator, or the next secret will solve all your problems. The allure of the perfect strategy is powerful because it promises control in an uncontrollable environment. Trading is unpredictable. Markets don't care about your plans or feelings. But when you focus on the strategy rather than your consistency, you're trying to control what you cannot control. And that's a recipe for frustration and failure. Think about it in everyday terms. Imagine a student who buys the most expensive test prep course but never studies consistently. Or a person who buys every fitness gadget in the world but never follows a routine. No matter how perfect the tools are, results only come from showing up day after day. Trading is exactly the same. You can have the best strategy in the world, but if you can't execute it consistently, it won't matter. Consistency isn't glamorous. There are no flashy indicators or secret setups that promise quick money. It's boring. It's repetitive. It's disciplined. But here's the paradox. It's also the most powerful edge in trading. Consistency compounds over time. Small disciplined actions, taking trades according to your plan, managing risk, controlling your emotions, build a foundation that no strategy can replace. It's the difference between someone who occasionally makes big wins but can't sustain them, and someone who steadily grows their account, year after year. Let's talk about edge hunting, which is what keeps most traders stuck in a loop. Edge hunting is the constant search for an elusive formula that will give an unfair advantage. Traders spend countless hours testing new strategies, indicators, or setups, hoping to find that one thing that will make trading easy. The problem is, they never realize that they already have an edge, their ability to execute consistently. They overlook the power of discipline and routine because it doesn't feel exciting. But in reality, execution beats edge every single time. You can have a perfect strategy that wins 70% of trades, but if you fail to follow your rules, take trades impulsively, or overtrade, your results will still be a mess. Consistency also helps you survive the inevitable losses. Every trader loses at some point. No strategy works 100% of the time. The difference between a trader who survives and one who fails is not their chart setup. It's their ability to stick to a consistent approach even when the market tests them. Consistency builds resilience. It gives you a framework to handle losses without panicking, to cut losing trades without hesitation, and to stay calm when the market behaves unpredictably. I've seen traders make the same mistake over and over. They find a strategy that works for a month, then abandon it the first time it hits a losing streak. They move to the next hot strategy, chasing excitement instead of building skill. Over time, this behavior destroys accounts, confidence, and trading psychology. It's not a lack of intelligence or talent, it's a lack of consistency. If you want to succeed in trading, the first step is to accept that there is no perfect strategy. There's only perfect execution, repeated consistently. Storytelling can help make this clear. I once worked with a trader named Mike. Mike was brilliant. He could analyze charts, read news, and spot patterns better than most. Yet he struggled to make money consistently. He blamed the market, blamed his broker, blamed the time of day, anything but his own behavior. When I asked him to follow one simple rule, trade only one setup he understood, and follow it for 3 months, he resisted. But I could make more if I try this new strategy, he said. 3 months later, after sticking to his plan, Mike not only made consistent profits, but he also regained confidence. He realized that the edge was never in the strategy itself. It was in his ability to act consistently, to control risk, and to manage his psychology. That insight transformed his trading forever. So, what does consistency really mean in trading? It means showing up with the same rules every day. It means entering trades according to your plan, setting stops, managing position sizes, and following risk management principles, even when you feel impatient, scared, or greedy. It means journaling your trades, reviewing mistakes without judgment, and learning from them. It's a commitment to process over outcome, routine over excitement, and discipline over ego. Consistency also affects your mindset. When you focus on consistent execution, rather than chasing the next perfect strategy, your confidence grows. You stop feeling like a victim of the market. You start seeing trading as a skill, something you can improve over time, instead of a gamble where luck decides your fate. And as your confidence grows, your decision-making improves, your emotional reactions decrease, and your results start to reflect your effort and discipline rather than random chance. Many traders overlook this because they want shortcuts. They want strategies that promise instant riches. But here's the hard truth. There are no shortcuts in trading. The market doesn't reward wishful thinking. It rewards consistent, disciplined behavior repeated over time. Every successful trader in history, from Jesse Livermore to Paul Tudor Jones, shares this trait. They didn't get rich by hopping from strategy to strategy. They got rich by mastering themselves and their routines, and letting consistency compound their edge. Finally, remember this. The illusion of the perfect strategy is seductive, but it's a trap. The market will always test you, always challenge you, and always expose weaknesses in your execution. If your edge depends on finding the perfect setup, you'll constantly be disappointed. But if your edge depends on your consistency, you will not only survive, but thrive. You will build confidence, resilience, and mastery. You will transform trading from a gamble into a career, from stress into skill, and from chaos into clarity. Chapter 1 ends with this essential truth. Stop chasing strategies. Start mastering yourself. The edge is not in the charts, the indicators, or the setups. It is in your ability to show up, follow your plan, control your emotions, and execute consistently. That is the real trading edge, and it's available. Chapter 2. Discipline is important than signals. Imagine this. You see a trade setup that looks perfect. Every indicator lines up, the news seems favorable, and your chart paints a story of potential profit. You feel excitement building inside, almost like a lottery ticket about to hit. You place the trade, only to watch it go against you 5 minutes later. You swear it's not your strategy. It must be the market's fault. This scenario plays out every day for traders around the world. The truth is, the problem rarely lies in the chart or the signal. It lies in your discipline, or lack of it. Discipline in trading is not glamorous. It doesn't get clicks, views, or Instagram screenshots. It's invisible, but it is the true engine behind every consistent trader's success. Without discipline, even the most perfect setup will fail you. You can have the fanciest indicators, the latest AI tools, and access to real-time news. Yet without the ability to control your actions, you are gambling. Trading signals without discipline are like giving a hyperactive child a Ferrari and hoping they don't crash. I remember my first months as a trader. I was obsessed with indicators, moving averages, RSI, MACD, stochastic. If it had 3 letters, I wanted it on my chart. I thought more data meant better decisions. But my results told a different story. I would see a signal, jump in impulsively, then panic the moment price moved slightly against me. I didn't even follow my own rules because I lacked the habit of discipline. Over time, I realized that signals were meaningless without the ability to execute a plan consistently. It wasn't the strategy failing. It was my mind sabotaging me. Our brains are wired for instant gratification, not long-term results. Evolutionarily, we are designed to seek reward quickly, catching the mammal, finding the berry, avoiding danger. Trading doesn't reward impulses. It rewards patience, planning, and control. Every time a trader jumps in on a hot signal without thinking, they are letting biology run the show. Discipline is the bridge between instinct and intelligent action. It's the ability to act when others panic, to wait when others rush, and to follow rules even when your emotions scream otherwise. Discipline also protects your capital. Money management is critical, and every signal comes with risk. Without discipline, traders over-leverage, chase losses, and violate their own stop-loss rules. I once met a trader who treated every signal like a guaranteed jackpot. He ignored his risk limits, doubled down on losing trades, and eventually lost everything. The signals didn't fail him. The discipline did. Without the structure to follow risk rules, even a signal with a 90% probability can destroy an account. Daily discipline doesn't just apply to placing trades. It extends to routines, journaling, and reviewing mistakes. Consistent traders don't just trade. They study themselves. They journal entries, track emotions, and evaluate outcomes with cold objectivity. This routine builds self-awareness, which is essential to maintain discipline. Most traders skip this step. They focus only on the market, hoping it will teach them discipline automatically. The market will teach many lessons, but most of them are expensive. Journaling and self-review are free ways to practice discipline daily without risking capital. One of the most powerful examples of discipline in trading is controlling emotion. Fear and greed are always lurking. Fear can make you exit too early, sell your winners, or avoid good setups. Greed can push you to overtrade, ignore risk management, or chase losses. Discipline is what keeps you grounded. It's the quiet voice reminding you to stick to your rules, even when your heart races. Every trader faces these emotional battles. What separates the consistent from the inconsistent is not intelligence or strategy. It's the ability to obey the rules when emotion tells you to do otherwise. I like to use a simple story to explain this. I once worked with a trader named Lisa. Lisa was brilliant at spotting opportunities, but she had no routine. One day, she saw a setup that felt perfect. She entered without her usual risk assessment and doubled her position size because she was excited. The trade immediately went against her, and panic set in. She closed early, frustrated, and swore she would never trade again. A week later, she tried the same strategy but followed her routine, respected position sizes, and controlled her emotions. The result? A profitable trade. The difference wasn't the market, it was her discipline. Following the rules consistently turned a guessing game into a repeatable process. Discipline also means saying no. No to impulsive trades, no to overtrading, and no to emotional revenge trading. Every profitable trader I've met practices this consistently. They don't jump at every signal or rumor. They wait for setups that meet their strict criteria. The discipline to say no is harder than placing trades. It's human nature to want action, but trading is more about waiting for the right moments than doing something every day. Waiting and watching is part of the game. Signals are useless if you don't have the discipline to decide which ones to act on. Another aspect of discipline is staying consistent with risk management. The best signals can fail, and losses are part of trading. A disciplined trader knows exactly how much risk they can take, never exceeding it. They understand that protecting capital is more important than chasing a winning streak. I've seen traders make 10 consecutive correct decisions and then wipe it all out because they broke their own rules. Discipline ensures that you survive losing streaks and live to trade another day, which is the ultimate edge in any market. Consistency through discipline also compounds over time. Think of it like building muscle. You don't become strong overnight by lifting once. You get stronger by repeating disciplined workouts every day. Trading works the same way. Following a disciplined routine, reviewing trades, controlling emotions, and respecting risk rules builds skill, confidence, and eventually, profitability. Signals are tools, but discipline is the engine that makes those tools work. It's also important to recognize that discipline isn't about perfection. Even the best traders make mistakes. What matters is recovering quickly and sticking to your plan. Discipline is forgiving. It allows you to learn from mistakes without derailing your progress. Inconsistent traders punish themselves for errors, chase losses, and spiral into emotional trading. Disciplined traders acknowledge mistakes, adjust, and continue. Over time, this small difference makes a huge impact on results. Let's talk about routines. Daily routines are a form of discipline. Waking up at the same time, reviewing charts, journaling, planning trades, and reflecting on performance are habits that create structure. Structure reduces impulsive decisions. A trader without structure reacts to the market. A disciplined trader responds. It's the difference between gambling and skillful trading. A signal may tempt you to react, but discipline ensures you respond correctly, according to your rules. I've seen this principle in action countless times. One trader I mentored had a streak of 15 losing trades. Most traders would panic, abandon strategies, and look for shortcuts. But he had the discipline to follow his plan, stick to risk limits, and journal every trade. By the 16th trade, he was back in profit, not because of luck, but because he let discipline guide him, not emotion. Signals came and went, but his consistent behavior carried him through. Finally, discipline is the true edge that signals can't replace. Markets will always send mixed messages. News will contradict charts. Indicators will disagree. Only a trader with discipline can navigate this chaos. Discipline allows you to filter noise, follow your rules, and make decisions that compound over time. No signal, no matter how accurate, can substitute for this. It's not about chasing setups. It's about training yourself to act correctly every single day. Chapter 2 leaves you with this essential lesson. Focus less on signals and more on your behavior. Mastering discipline is mastering trading. A consistent trader doesn't fear losses, panic at signals, or chase shortcuts. They plan, they execute, and they reflect. Every profitable trader you admire didn't get there by reacting to signals. They got there by reacting to themselves correctly. Signals may point the way, but discipline is the vehicle. Chapter 3. Small wins, big results. Have you ever thought that success in trading comes from massive breakthroughs? The truth is, it rarely does. Most traders expect huge wins to transform their accounts overnight. They dream of the one perfect trade that will change everything. But the real magic happens not in the big trades, but in the small, consistent actions that compound over time. Small wins are deceptively powerful. They may feel insignificant in the moment, but when repeated consistently, they create results that can be life-changing. I remember a young trader named Alex. He was desperate to grow his account fast. He chased big gains, jumping into trades with large positions, ignoring risk rules, and hoping for lightning-fast profits. The result? A series of crushing losses. Frustrated, he almost quit trading. Then he made a simple decision. Focus on small, manageable trades and follow a disciplined routine. He started risking a tiny fraction of his account, reviewing his trades daily and celebrating even small successes like sticking to his stop-loss or following his plan perfectly. Within months, Alex's account started growing steadily, not because of a miraculous trade, but because of consistent small wins. Over time, those small wins added up to significant results, and Alex realized the power of compounding in trading. The principle is simple. If you improve 1% every day, by the end of the year, you'll be 37 times better than when you started. It sounds unbelievable, but it works. This is the compounding effect of small improvements. In trading, small wins could be sticking to your plan for a day, logging every trade in your journal, improving your risk management, or simply controlling your emotions in a difficult market. Each win seems minor, but when repeated consistently, they create a snowball effect that turns average traders into exceptional ones. Many traders underestimate this power because they are addicted to excitement. They focus on the big wins, the thrilling setups, and the massive profits that appear in flashy YouTube videos. They ignore the slow, methodical steps that actually create sustainable success. But the reality is that trading is more marathon than sprint. Long-term profitability is not built on occasional genius trades. It is built on disciplined, repeatable actions that accumulate over time. I've seen this play out countless times. One trader I mentored, Sarah, used to obsess over market predictions and news events, thinking they held the key to wealth. She'd spend hours analyzing charts, searching for the perfect moment, and often missed good trades because she was chasing perfection. I encouraged her to focus on small wins instead, executing trades according to her plan, managing risk properly, and reviewing her performance daily. At first, it felt boring. There was no instant gratification, no aha moment. But over months, Sarah noticed a transformation. Her trades became more consistent, her losses smaller, and her confidence grew. The accumulation of small wins created a bigger result than any single trade ever could. Small wins also help to build confidence, which is often overlooked in trading. Confidence is not about knowing you'll never lose. It's about trusting your process, believing that your routine and discipline will guide you through losses, and understanding that your edge comes from consistent behavior, not luck. When traders focus solely on outcomes, they tie their confidence to results, which are volatile and unpredictable. Small wins shift that perspective. They let you measure progress based on controllable actions, not external outcomes. By celebrating small victories, you reinforce your habits, improve your skill set, and gradually build the mental strength necessary for long-term trading success. Another key aspect of small wins is habit formation. Consistency is easier to maintain when success is broken into small, achievable actions. For example, committing to reviewing one chart per day, journaling one trade per session, or following your plan for even a single trade without deviation are small actions that gradually form habits. Over time, these habits become automatic. You no longer have to force yourself to act correctly. It becomes your default behavior. This is the real power of small wins. They turn deliberate effort into natural competence. I often tell traders to view their progress as a staircase, not a leap. Each step represents a small win. You may not feel the impact immediately, but with each step, you rise higher. Missing a step or taking shortcuts doesn't just slow progress. It can derail confidence and create frustration. Conversely, celebrating each step keeps motivation high and reinforces positive behavior. The staircase analogy also highlights another truth. Trading success is cumulative. There are no shortcuts to the top. and trying to jump steps usually results in falls. One of the most practical ways to achieve small wins in trading is by setting micro goals. Micro goals are simple, achievable objectives that are fully under your control. For example, today I will risk no more than 1% of my account per trade, or I will follow my plan exactly, regardless of the outcome. These goals are small, measurable, and repeatable. Completing them consistently builds momentum, and over time, the cumulative effect is astonishing. Traders often overlook the compounding effect of these micro goals, thinking only large achievements matter. Yet in reality, small, consistent actions define success more than any single massive trade. Storytelling is particularly effective in illustrating this point. I once worked with a trader named Jordan who was frustrated with his slow progress. He wanted his account to double in a month, so he took aggressive positions and over-leveraged. Predictably, he lost a significant portion of his capital. After this, we shifted focus to small wins. Jordan's first micro goal was simple: follow his trade plan for 1 week without breaking any rules. He achieved it. The next week, the goal was to journal every trade without skipping a day. He did it. Each week, we added one more small, manageable improvement. Within 3 months, Jordan's account wasn't just recovering, it was consistently growing, and his confidence had skyrocketed. By focusing on small wins, he rebuilt not only his account, but his mindset. Small wins are also critical for emotional control. Trading is emotionally taxing, and even seasoned traders face fear, greed, and frustration. By focusing on small, controllable actions instead of outcomes, traders can reduce emotional volatility. For instance, a trader who celebrates the small win of sticking to their risk rules is less likely to chase a loss or overtrade. Each small win reinforces self-control, gradually reshaping the trader's psychology. Over time, this emotional stability becomes a massive edge in the market, far beyond what any indicator or strategy can provide. It's important to understand that small wins don't always feel exciting. They often look boring on the surface, reviewing trades, following risk rules, or executing a plan without deviation. But boring consistency beats exciting chaos every time. Big wins come and go, but small, repeatable successes build lasting results. In fact, the biggest surprise for most traders is realizing that their cumulative small wins can produce results far larger than any single trade could have achieved. Another aspect of small wins is resilience during setbacks. Every trader faces losses, the market is unpredictable, and even the best strategies fail at times. Small wins provide a framework to recover from these setbacks. By focusing on controllable actions rather than outcomes, traders maintain confidence and motivation. For example, a trader may lose a trade due to market volatility, but if they followed their rules perfectly, they have still achieved a small win. Recognizing and celebrating this helps traders stay consistent, avoid revenge trading, and build momentum toward larger goals. The compounding effect of small wins also extends beyond trading performance. It improves self-discipline, patience, and decision-making skills, qualities that influence every area of life. Traders who master small wins often report improved focus, reduced stress, and better long-term planning. These secondary benefits create a positive feedback loop, where personal growth reinforces trading growth, and vice versa. Let's return to Alex for a moment. By focusing on small wins, he not only improved his trading account, but also transformed his mindset. He stopped obsessing over unpredictable outcomes and started controlling what he could: his actions, his risk, and his routine. Over time, he became a disciplined, confident trader who no longer feared drawdowns or losing streaks. The accumulation of small wins created a dramatic shift in both his trading results and his life perspective. Finally, the principle of small wins teaches a critical lesson. Trading success is not about chasing perfection or luck. It's about committing to a series of correct actions repeated consistently over time. Every profitable trader from Warren Buffett to Paul Tudor Jones, understands this principle intuitively. They don't rely on luck, hot tips, or miraculous trades. They rely on disciplined, repeatable behavior, compounded over years. Small wins are the foundation on which this. Chapter 4. The Boring Edge. Most traders chase excitement. They want the thrill of a fast-moving market, the rush of hitting a perfect entry, or the adrenaline from a massive overnight gain. They scroll through social media, watching other traders boast about huge wins and secret setups. In the process, they overlook the quiet, unglamorous actions that actually create lasting success. The truth is, the real edge in trading is often boring. It's repetitive, predictable, and seemingly mundane. But it works. This is the boring edge, and it separates elite traders from the rest. I remember a trader named Daniel. When we first met, Daniel was obsessed with finding the next hot setup. He wanted strategies that promised instant profits and spent hours testing every new indicator he could find. He rarely followed a routine, skipped journaling, and often ignored risk rules if a trade felt exciting. Unsurprisingly, his account fluctuated wildly. He would hit small wins, then lose them all in a week. The problem wasn't the market, and it wasn't even the strategies. The problem was his lack of discipline in embracing the boring but powerful routines that form the backbone of trading success. The boring edge starts with routine. Successful traders don't rely on inspiration or mood swings. They follow structured processes every day, regardless of how they feel. This might seem dull, but it's precisely what creates mastery. Waking up at the same time, reviewing charts systematically, following predefined risk rules, and journaling trades might feel monotonous at first. But repetition trains the mind to recognize patterns, manage emotions, and make better decisions. The magic isn't in one perfect trade. It's in the repeated execution of small, disciplined actions. I like to compare it to building muscle. No one gets strong overnight by lifting a dumbbell once. It takes repeated workouts, sometimes boring, sometimes exhausting, until the muscles strengthen and grow. Trading works the same way. Following routines, reviewing trades, and sticking to rules might feel repetitive, but over months and years, these actions build skill, confidence, and an edge that no flashy indicator can match. Journaling is another cornerstone of the boring edge. Many traders skip it, thinking it's unnecessary or tedious. But journaling is not about writing pages of fancy notes. It's about tracking your trades, recording your thoughts, analyzing mistakes, and reflecting on outcomes. This practice may feel slow, even boring, but it is where real learning happens. When you journal, you notice patterns in your own behavior: fear, greed, impatience, and overconfidence. Once identified, these tendencies can be corrected, and over time, this self-awareness compounds into a huge trading advantage. I once worked with a trader named Sophia, who despised journaling. She believed her instincts were enough, and that reviewing trades was a waste of time. Predictably, her results were inconsistent. After a particularly frustrating losing streak, she reluctantly agreed to journal for a month. At first, she felt the process was tedious, but within weeks she noticed recurring mistakes: entering trades impulsively, ignoring stop-loss rules, and overtrading on emotional whims. By addressing these issues, she turned her trading around, not through a new strategy, but by embracing the boring edge of journaling and routine. The boring edge also teaches patience. Most traders want immediate gratification. They expect results from one trade or 1 week of trading. But trading is more like planting a tree than striking gold. You water it, nurture it, and allow it to grow over time. By committing to repetitive, disciplined actions, even when they feel unexciting, you develop patience, which is critical to surviving drawdowns and avoiding impulsive decisions. Impatience is the enemy of consistency. The boring edge forces you to focus on processes rather than outcomes, which ultimately compounds into profits. Repetition also reduces mistakes. The more you repeat a process, the more automatic it becomes. This is why elite traders rarely panic. They have ingrained routines and processes that guide them in high-pressure situations. When the market moves against them, they don't react impulsively. They follow their plan. The boring edge creates muscle memory for the mind. By internalizing routines and rules, you reduce emotional trading, improve execution, and build resilience. Another example comes from my mentorship with a trader named Marcus. Marcus was talented but inconsistent. He would occasionally hit large wins, but they were always followed by emotional mistakes that erased gains. We worked together to implement a boring, disciplined routine. Reviewing charts every morning, journaling trades consistently, and following risk management rules without deviation. At first, Marcus found the process tedious. He wanted excitement. But after 3 months of sticking to the routine, his account stabilized, losses decreased, and his profits became predictable. He realized that trading success was not about chasing the next big setup. It was about embracing the boring, disciplined actions that created consistent outcomes. Boredom in trading is also a signal of mastery. When you feel bored, it often means you are doing things correctly, consistently, and systematically. The excitement usually comes from unpredictability or deviation, which often leads to mistakes. Elite traders find comfort in the monotony of their routines. They understand that sticking to the plan, following rules, and executing consistently is far more valuable than chasing thrills. The boring edge also builds confidence. Repetition and discipline remove uncertainty. When you have a routine, you know what to do in every market condition. You don't second-guess yourself because your actions are based on proven processes. This confidence is not arrogance. It's a result of consistent behavior that produces results over time. Even when losses occur, you trust the system and continue following your routines. This mental strength is a rare edge that many traders never develop because they are too focused on short-term excitement. Another critical aspect of the boring edge is risk management. Following strict risk rules may seem tedious or limiting, but it is essential for survival. By risking only a small portion of your account, using stop losses consistently, and avoiding impulsive decisions, you protect your capital and ensure longevity in the market. Many traders fail because they neglect these boring rules in pursuit of excitement. The boring edge, by contrast, enforces discipline that safeguards your account and allows compounding to work its magic over time. It's also important to note that the boring edge is not about being passive. It's about active repetition of the right actions. Elite traders are not sitting idly. They are actively following routines, reviewing charts, analyzing trades, and improving their process. The difference is that these actions are structured, predictable, and grounded in discipline. This creates an environment where mistakes are minimized, learning is continuous, and results accumulate steadily. I often tell traders that trading is like building a foundation. You cannot skip steps. Pouring concrete hastily, skipping reinforcement, or ignoring blueprints may produce a structure temporarily, but it will collapse under pressure. Similarly, in trading, skipping routines, ignoring journaling, or seeking excitement over consistency may produce occasional wins, but it will eventually lead to losses. The boring edge ensures that your foundation is solid, allowing your trading performance to grow sustainably over time. One trader, Emily, shared a powerful realization after embracing the boring edge. She had spent years chasing complex strategies, hopping between indicators and feeling the thrill of unpredictable wins. When she shifted her focus to routine, journaling, and repetitive process, she initially felt uninspired. But as her trades became consistent, she realized that the boredom was a sign of control. She no longer reacted impulsively, she made fewer mistakes, and she finally started seeing results that were sustainable. She learned that the market rewards patience and consistency, not drama or excitement. Another aspect of the boring edge is its effect on mindset. Repeating simple processes builds mental toughness. You learn to detach from outcomes, focus on actions, and avoid emotional swings. Over time, This mindset becomes automatic. Elite traders operate with a calm, controlled approach, rarely shaken by losses or surprises. The boring edge trains your brain to prioritize process over outcome, which is the key to long-term success. Finally, the boring edge creates a self-reinforcing cycle. Repetition builds skill. Skill builds confidence. Confidence reduces emotional errors. Reduced emotional errors produce consistent results. Consistent results reinforce routines. This cycle compounds over time, creating an unstoppable momentum that no flashy indicator or perfect setup can match. Boredom, in this sense, is a signal that you are on the right path. It is the hidden power that most traders overlook, but elite traders exploit every day. Chapter 4 leaves you with a critical lesson. Stop chasing excitement and shortcuts. Embrace the boring, repetitive actions that create consistency, skill, and resilience. Wake up, follow your routines, journal your trades, and repeat the processes that have been proven to work. Success in trading is rarely dramatic. It is the accumulation of small, disciplined actions repeated day after day. The boring edge is your secret weapon. Once you embrace it, the market becomes far less intimidating, and your results